What's going on, guys? This is Chandler Smith, and I am so pumped about today's video because I'm gonna show you how the rich use real estate to avoid paying any taxes. I'm gonna talk about cost segregation, accelerated depreciation, 1031 exchanges. I'm gonna show you how they work, how the rich use them, and how you can use them too. And the best part is if you use them properly, one, you get to avoid paying taxes, but two, you get to do it legally. And that's the most important part because we don't want you to end up in jail. So with all of that being said, let's jump into it. All right, guys, if you're new to the channel, I've been investing in real estate for the last 9 years. I own about $25 million worth of real estate. The majority of that is made up of the 162 units of residential real estate that I own. I've also got, I think, like 160, 170 storage units, and I've kind of messed around with a bunch of different things. The one thing that I've done a lot of on top of buying real estate throughout this time period is I've had the opportunity to do 1031 exchanges. I've used cost segregation every year for the last 3 to 4 years. And what cost segregation is essentially speeding up the depreciation on your properties so that you can use that depreciation against your income so you don't have to pay tax. Now, I know that's a lot that's thrown at you. Couple things I want to hit on before I dive into how the rich use real estate to avoid taxes, because you need to be very careful, one, in the way that you talk about this, and two, the way that you do it, because taxes are very important. Now, I pay a ton of tax every single year with property taxes on all of these properties, and historically, I've actually paid a lot of tax on the money that I made first from my sales job to then be able to purchase real estate, because when my main focus was my sales job and not real estate, I couldn't be considered a real estate professional. Now, this is a very stringent requirement that you have to meet to be able to use this strategy to be able to avoid paying taxes. And when I say avoid paying taxes, all that you're truly doing is deferring those taxes. At some point, they need to be paid. It's more of a deferment than something that you're not ever paying. And we're gonna talk about how this strategy can catch up with you, because at some point you have to pay this tax. But also, we're gonna talk about how I use this strategy so that I honestly will never pay tax unless I get access to these funds in a certain way. And that's why we want to talk about that as well too, because there are ways to access funds from your real estate without paying tax. And then there are ways where if you just sell your real estate and you actually take ownership of, or you liquidate the equity that you had in these properties the wrong way, then you're gonna get hit with a massive tax burden. And that's why you just need to understand what you're doing. For one, you need to make sure that you're doing it all legally, that you meet all the requirements that the government set forth. And that's why we're gonna talk about all of those things before we jump into how you actually use this strategy. The last thing I wanna say, and this is extremely important, I'm not a lawyer, I'm not an accountant. Do not take my legal advice. Please don't take my tax advice. But I'm gonna give you everything that you need to understand these principles so that then you can go back to your accountant, you can go back to your lawyer, and you can say, hey, Chandler presented this to me, here's how he uses it, here's what he does. Can this work with what I'm doing? And I'm really hoping that it can. So first thing you need to understand, if you are a passive investor in real estate, that's awesome, because you can use cost segregation, you can use accelerated depreciation from your properties to offset all of the money that you make from your rental properties. So let's say you've got a rental property. Every year it nets you $5,000, but it is a passive investment. There is a way, when you're not a real estate professional, to use your depreciation against that income so you don't have to pay tax on it. But if you're a W-2, 1099, you own your own business, you've got income coming from somewhere else, that's the income you use to buy the property, you cannot use that depreciation or the losses from your passive investment against these gains unless you are considered a real estate professional, which means most likely these gains are coming from real estate, or the majority of your income, your time, et cetera, is coming from being a real estate professional. Now, I know this seems like a lot, but you need to determine whether you're a real estate professional or not a real estate professional, because if you are a real estate professional, this gives you the ability to use all of the depreciation, and you can actually accelerate that depreciation so that you can use it against your losses. And I'm gonna talk about that, so don't get overwhelmed. Just know to really reap the benefits of real estate like the rich do, you need to be considered a real estate professional. Now, if you can't be a real estate professional, you just need to take it against your passive gains. But there is a life hack, because if you're married filing jointly, your spouse can become a real estate professional and you can still get all of the benefits. So let's say you've got a job that's a cash cow, you want to put it into real estate. There is kind of a way around this, because you can have your spouse become a real estate professional by meeting these requirements. So we're gonna dive into the requirements, and then I promise you all of this stuff that I'm saying that seems overwhelming won't be overwhelming, because I'm gonna break it down very simply so you can take advantage of these strategies that the rich use to avoid paying taxes, or at least defer paying taxes indefinitely. All right, guys, so here are the requirements that you need to meet to be considered a real estate professional. And I'm just gonna read it, even though it's more legal talk. It says, a taxpayer qualifies as a real estate professional for any year the taxpayer meets both of the following requirements. Number one, more than half of the personal services performed in all trades or businesses during the tax year were performed in real property trades or businesses in which the taxpayer materially participated. Number two, the taxpayer performed more than 750 hours of services during the tax year in real property trades or businesses in which he or she materially participated. Now, I had to move some things around in my business, find people to fill in my sales organization so that I was doing less and do a lot more in real estate. That's one of the reasons I've been able to scale so quickly the last couple of years as I've been using this. Unfortunately, there were years where I had bought a fair amount of real estate that I wasn't yet a real estate professional. I didn't meet these requirements. And because of that, yeah, I didn't get to take advantage of these things. The other thing is we've also taken the proper steps so that my wife can be considered a real estate professional, just to double, triple, quadruple, make sure that we're not stepping on any toes and we're doing things right. And the majority of the property bought this year was actually bought by my wife, which is really cool. It's been a blast for us to team up and do all the things that we do together. So make sure that you find a way so that you can at least meet these requirements, or if possible, that you and your spouse can both meet these requirements like what we've done, because when you do that, it's gonna put you in a great place. Now, you can do this by becoming a realtor. So maybe you have your wife become a realtor and she does all of your transactions. She's doing other transactions. That's a great option. Maybe she's just managing, taking care of your properties, doing everything when it comes to the systems of purchasing properties, or not even everything, just doing a majority so that she can meet the 750 hours every year, and so that she can also meet the requirement of it being the majority of your work, more than half that goes into it. Now, I'm not going to dive into this more. If you've got questions, talk to your accountant, talk to your lawyer. But if you meet these requirements, now you enter the realm where any income that comes into your family, if you're paying taxes jointly, now you have the ability to use your depreciation or losses from your real estate against your income. Now, I'm sure there are a lot of you saying, Chandler, how does this work? Help me understand what you're talking about. So here's how it works. When you buy property, the government has put together a depreciation schedule for that property. For example, a car depreciates faster than a house. So if you own a car, it's on a depreciation schedule. Things like technology depreciate way faster than things like, I don't know, a property. A property, if you just depreciate the whole property, you don't break things down, that property depreciates, I believe it's on a 27 or 28 and a half year schedule. I think 27 and a half, could be wrong. Anyways, that's a long depreciation schedule. So if you are not considered a real estate professional, what you might do is you might do a more, or I guess not so dialed in version of accelerated depreciation, or also referred to as cost segregation. Now, what cost segregation is it's when you've got your property and the government looks at your property and says, oh, that depreciates on a 27 and a half year schedule, or 28 and a half. I'm just gonna look it up. Haha, I was right. It was a 27 and a half year schedule, or I was kind of right. I guessed one of those two. So again, if you are one of those people that does not qualify as a real estate professional, you talk to your accountant. Some of the easy things to depreciate on a faster schedule are like if you've got a fridge, oven, washer and dryer. You can look at flooring. That's something that's easy to depreciate. You can have them accelerate the depreciation on those couple things and just get the depreciation you need, because some things might be on a 3-year, some things might be on a 5-year, on a 7-year, or on that 27.5-year schedule. Now, the reason that I'm saying you could just have your accountant do that is that's not getting super detail oriented, breaking down every part of the property. And then you just fall back on what the government gave you of a 27.5-year schedule. That way, if you're making $5,000 to $10,000 net every year, you can make sure that depreciation that you use meets that amount. And if you go over that amount, it can carry forward. And so it's not an issue because you just use what you've got to use, and then it carries forward every year to use in the future. So that is if you're not considering yourself a real estate professional. If you are considering yourself a real estate professional and you are in a high tax bracket, that's the other thing you need to take into consideration. If you're not in a high tax bracket, maybe you want to drag out the depreciation because you know eventually you're going to have a bigger tax burden, or that's your plan. If you're like me and you're in a high tax bracket, you want to knock off everything out of those high tax brackets where you're paying 40, 45% between your state and your federal tax. I don't want to pay anything in those brackets if I can afford to. So then I pay someone to come and do a study of my property. Now, what they're going to do is they're going to go and nitpick every single thing in the property. They're going to do the flooring. They're going to do the fridge, the washer and dryer, all the things we talked about, but then they're going to go into detail on all of the nitty gritty stuff. They're going to go and look at the concrete. They're going to give it a usable life. They're going to go at the doorknobs. They're going to go and look at your electrical. They're going to go and look at your roof. They're going to go and look at the sheetrock. They're going to look at literally everything and give it all a schedule. And there's also something called bonus depreciation. I'm not going to dive into that, but essentially what they're doing is they're speeding up your depreciation as much as they possibly can so that you can take as much as you possibly can in year one. So for me, when I have done cost segregation, depending on the property, I get anywhere from 35 to 45% of the entire purchase price that I can depreciate year one. What this does is it gives me the ability to offset all of the net cash flow that I get from the property and have extra left over that I can use against my other income that didn't come from the rental properties. So this gives me the ability to literally knock off all of my income or my taxable income, knock it down in a legal way using depreciation so that I can knock my tax bracket down sometimes to literally zero or down to where I'm in the 10% bracket, and that's all that I'm paying in taxes every single year. Now, there are a couple things that you need to take into consideration, and then I'm going to show you an example of exactly how the numbers on this work so that you understand it. But the one drawback is if I use all of the depreciation year one, then I've got year two where this property is cash flowing and it's making me money that I might not have enough depreciation to offset that. So now that's new income. So you're kind of consistently kicking this tax burden down the road. And that's why if I ever get to a year where, just for example, let's say I'm making a couple $1 million, because I am that sounded bad, but I'm making a couple $1 million every year. And I want to mitigate my tax burden or lessen my tax burden or defer that's the best phrase, defer my tax burden down the road. And so I use all of that depreciation. But then the next year comes, if I don't buy more real estate, now all the income I have come in, not only from my rental properties, but my other businesses, I'm going to have to pay tax on all of that. And so the only way that you can continue to not pay taxes is if you continue to buy a ton of real estate. So some people would say, oh, Chandler, that's terrible. Well, here's the deal. Essentially, the phrase is something in your hands is better than something in the bush. Yeah, it's a bird, I think. Haha, I've got it. Bird in hand is better than two birds in a bush. Yeah, something like that. Yeah. So when it comes to taxes, my view is if I can legally defer those taxes, and maybe I won't be able to buy properties one year and maybe I'll get hit with this massive tax burden, but by deferring those taxes legally, it gave me the opportunity to buy more real estate, to make more money in the meantime. And then if I've got a huge tax burden I've got to pay in the future, I'm okay with that because again, I'm not able to use the depreciation because I already used it, but then you're just still paying taxes on what you've made that year. And so as long as you can continue to buy real estate, you can continue to defer this. If you look at the biggest real estate moguls, every year they're paying zero tax because every year they're buying enough real estate to offset all of their income with that depreciation. This is another reason that people like using a 1031 exchange and why a lot of investors were freaking out that the 1031 exchange might disappear, and here's why. What the 1031 exchange allows you to do is when you're looking at a property, let's say you've got a $1 million property, all right? Now, a portion of that property is land. You cannot depreciate land. So now you're brought down to $700,000. What I've come to find is of your total purchase price, you can usually get 35 to 45% of it. And that's of the whole million. Not because you're taking from the land, but that's just easy math for me when I buy a property because the land value usually ends up about the same. So now I can take 30 to 40% from the total purchase price. I only have a little bit of depreciation left, and I'm going to use that in the next couple of years. And so once you have depreciated the majority of your property, what people will do is they'll say, all right, I've gotten all of the depreciation, I've added value to this property, I can't milk any more depreciation, and I need to buy more real estate. So I'm going to sell this property, but do a 1031 exchange. Now what happens is you sell it to someone else, but you can't touch that money. It just has to go into a new property. So let's say you've got $1 million property, property value is worth $800,000 and you've depreciated $750,000. Well, that stays with the 1031 exchange, but you've freed up a ton of cash because maybe your $1 million property has now become worth $2 million. You've got a ton of cash you can move out and your basis is going to start based on what you've already depreciated. So for example, if you've depreciated $750,000 in this new property you buy that's worth $4 million, you've already used up $750,000 of it, the depreciation on this property, but now you can still accelerate the depreciation, do it all over again, and you got access to this money to put into another property. One of the other strategies that you can use is you can refinance the property because anytime you take debt out on your property, the good news for you is you don't have to pay tax on that. So let's say I buy a property for $1 million. I use up all of my depreciation in the first couple of years or even the majority of it in the first year. And now I'm left with a property that's cash flowing, it's making money, but I can't use any more depreciation. Well, I can go and take out a new loan on the property. I can pull out a ton of cash, put it into a new property and not pay any money on that because this is still financed. Now that might even affect my cash flow, so it's less because now I've got a greater interest payment, which I'm okay with because now I've got this money going to work for me over here and I didn't have to pay taxes on anything that happens. The only thing you would have to pay taxes on is if you didn't do a 1031 exchange or you didn't borrow more against the property, you just sold the property and you took all the cash out and now you're hit with a massive tax burden, which the only way you could offset that tax burden is if you bought a ton of property and accelerated the depreciation on that, which wouldn't make sense because you should have just kept this property and done a 1031 exchange. So I think I covered all of that. So now I can give you an example that will hopefully make all of this make sense. But here's the deal. I did a consulting call recently with a real estate investor that had no idea about this strategy. And he started using it and it saved him literally hundreds of thousands of dollars. And a lot of times your accountant is just lazy or they don't want to do the work to, well, yeah, that's the same thing as being lazy. They just are scared to do it because maybe they've never done it before, but there are accounting firms that this is all they do. And so I've got my accounting firm that does my taxes, but then for the cost segregation, you want to make sure you turn it over to a firm that this is all they do and they do the studies properly and they charge a decent amount. But when I've done the math on it, it makes sense to pay them to do this study so I can accelerate my depreciation. And so I'm telling you, take advantage of this because everyone I've showed it to that invests in real estate, it's been an absolute game changer for them to scale their business more quickly by deferring those taxes so they can buy more real estate. Now, I've talked a lot, but this is really going to hit home and make sense when you see numbers. So I'm going to pull up numbers on the screen and I'm going to use a $1 million property so that this is simple for you. Now, if you're buying smaller properties, understand this works the same way, but you need to do the math to see if you paying the money for the study is worth accelerating your depreciation for what you get back. And the reason you need to do that is because on these smaller properties, you're having to pay a pretty good fee to have them do it, where your fee gets lower and lower because if you buy a 100-unit apartment complex or even a 30-unit apartment complex like my biggest one, they just go and they look at one unit and then they multiply it by 32 and they don't have to spend nearly as much time and it doesn't cost you nearly as much money. Where if you just have a single family home and you're trying to accelerate the depreciation, you might do the math on it and it might not make sense because of the fee you have to pay to get the study that goes and individually breaks down things. And you don't want to just have your firm BS it, because if you push your accountant to just do it and he's not a professional and he doesn't do it properly, then again, you can end up in trouble. And again, when you're messing with taxes, don't do anything stupid. Don't push the line because it's not worth ending up in jail. Do things straightforward. Make sure that you're with a firm that has been through this, that has been through audits, that knows what they're doing with cost segregation and accelerating that depreciation. So now it is time to jump into the numbers that are going to make sense for you. We're going to do this example with a $1 million property. Now, so you buy a $1 million property. Part of that is land and part of that is the actual property. You can only depreciate the portion of the property, but I have come to find, regardless of where it is, unless you've got something that's just got a ton of land and then a small property, usually you can take between 35 and 45% of the purchase price year one if you're with a cost segregation accounting firm that knows what they're doing. So this is how it works. When you look at a property, you buy it for $1 million. And I'm gonna have my calculator here so that I know what I'm doing. If you do it right, which I usually try to, you try to buy the property so you only have 25% down. So that means for this $1 million property, I had to purchase it with $250,000. Now you might do 30% down, so now you're at $300,000, but for the sake of running this math, we're gonna show you how to do it with a 25% down. If you're like, Chandler, my bank will only give me 30% down, then negotiate with the seller to get cash back for fixes or things that need to be done. And as long as your appraisal comes in so they can give you that cash back, that can lower your cost to close, which is another beneficial life hack that I do. And that's why on a lot of properties, I'll get even lower than 25% down, maybe 20, 18, 15, whatever it is. But again, we're gonna use 25% down for this example. So you had to come up with $250,000 to put as a down payment. Let's say you made $500,000 or $1 million or $2 million, whatever it is, you're gonna have to use $250,000 of that to buy the property. So now you've spent $250,000 on this property, but if you do cost segregation properly and accelerate the depreciation, that should give you, again, that 35 to 45% in depreciation to use against your taxable income. So that gives you another $100,000 to $200,000 that you can use against income, again, if you're a real estate professional. So if we dive into this, let's say that I just bought a killer property for $1 million and I'm getting a 20% return on my initial investment with cash flow. That would end up being, so $250,000 is my down times a 20% return. That's leaving me with a $50,000 return on that investment. So that's my cash flow. So first off, I have to use the depreciation against that. So now I've used 50,000 of my 1 to 200,000 that I have. That now leaves me $50,000 to $150,000 in depreciation I can use year one against taxable income that is going to lower my tax burden that I can use against other income that's come in. So now you take that off of your taxable income and you realize that, hey, if I buy this much real estate, I don't know what your income is, but if I buy this much real estate every year, I know I'll be able to offset my cash flow from my real estate and I'll have this much extra to offset the cash flow from previous rental properties I purchased or other income that I have coming in, so that you know exactly how much you need to buy every single year to be able to not have to pay tax on the money coming in. So the one thing that people don't realize is the second you stop buying real estate, now all of your income, the cash flow from all of your properties and any income coming from other businesses or other revenues that you're bringing in, probably sounds funny, but you know what I mean. you're gonna have to pay tax on all those. They're gonna count as taxable income because you're not gonna have any depreciation left because you accelerated that depreciation. And so now you're left with the burden of every year buying enough real estate to offset that tax burden. So a lot of people will say, Chandler, I don't wanna go through all that. I'm just gonna do it on the 27.5-year schedule. I'll take whatever it gives me and I'll pay tax on the rest because I don't wanna worry about getting hit with a bigger tax burden down the road. I think that's foolish, but I can also understand because maybe people are fine paying taxes. Maybe they think that taxes are only going to go up and they don't want to have the stress, maybe getting hit on their income later. Maybe they don't like the idea of paying the fees because I think last year I probably paid $15,000 to $20,000 in fees for these cost segregation studies. And so you've got to take that into consideration because that's money out of your pocket. Again, something you can use as an expense against your taxable income, but it is part of this equation. But I've come to find that it is so worth it to save 40, 45%, and then at the 35%, 32, 30, at all of those tax brackets, it's worth it to eliminate those by accelerating my depreciation so that I keep that money and I can use it the next year to buy even more real estate to offset my tax burden. And I have no problem every year doing this strategy. Now, here are some issues with the strategy. One, the issue we talked about where if you don't buy real estate, you're stuck. Two, if you buy the properties in cash or you're putting 40% down on the properties, essentially you're only getting the offset on what you've spent. Or if you're paying cash for the property, you won't have enough to offset what you spent. So for example, let's say you make $1 million in a year and you spend $1 million on $1 million property, but you only have that 30 to 40% to offset it. You're still going to have all of this money that you made that you spent all of it on real estate, but you don't have enough to offset your depreciation. And now you've used it all in the beginning. And so that's another reason you should never buy a property cash. But there are these little things where if you don't do it properly, you're not going to get the offset that you want. You're going to use too much offset on the front end, and then you're not going to have it on the back end. Or you're going to go to a firm that doesn't know what they're doing. They do it incorrectly. You get audited and you get totally burned. But if you do things properly, if you go to a good accountant, if you accelerate this depreciation, if you buy property every year and you truly are a real estate professional, you put yourself in a place where you can never pay tax because every year you buy bigger and better. It lets you spend less on taxes so that you have more to purchase property, so then you can pay the government more property taxes. And that's the one other note that you need to remember is all of your expenses, your property taxes, expenses on the property, management, all of that stuff, that's not taxable, so that offsets itself. And you're left with your cash flow that now you can use the depreciation to offset that and any other income. So, in layman's terms, if you've got money that you want to spend and you've moved into those higher tax brackets, realize that for every dollar you spend in real estate, you can get a dollar and a little bit back against your taxable income. So every year you're in a place where you can keep a little income for yourself from whether it's from your cash flow or the other businesses. But as long as you spend the right amount, you're not going to have to pay tax on that little bit you keep for yourself or all of the money you spent on real estate because of the depreciation that you accelerate. So if you use this strategy, you could grow to a multi-million-dollar real estate portfolio that's making you millions of dollars without ever paying tax, as long as you continue to take all of the income that you make and pour it right back into real estate and accelerate the depreciation on all of the real estate you buy, and always either 1031 to get access to that money where you buy new properties, or refinance or borrow against that property so you don't have to pay tax on that income. If you use this strategy, you can make it so that you can completely defer taxes forever. Final point. A lot of people say, Chandler, this sounds like a terrible strategy because you're just building this bigger and bigger will of tax burden that eventually you're going to have to pay down the road. You know, if you sell this property down the road, you're going to get absolutely creamed on taxes to be able to get access to that money. Well, here's what I would say. I don't think I'll ever need access to that money. I've got consistent income coming from the properties that can be offset. I have all that I need to afford my house and cars and family situation and to be able to give back. And as long as I do this properly, I'm going to leave my kids with a massive tax burden. But all a massive tax burden means is access to tons of money. And I'm going to tell them to use the same strategy. It also puts me in a place where I've come to find out that there are creative ways to give back. so that when you give back, now you're not getting beat up on this tax burden. So now I can build up this massive portfolio. I can give back all the way along the way. And then if I ever want to get access to it, I can give back in a big way. And I've completely avoided the tax burden. I've been able to get all of the things that I want. And then I've been able to choose how I give back rather than giving all this money to let the government choose how they give back. And this isn't anti-government. I'm pro-government. That's why I pay a ton of property tax and why I paid a lot of taxes getting to the point where I could be a real estate professional. But this gives me the opportunity, in my opinion, to provide for my family, to have the things that I love, and to give back in a much bigger way throughout the process and down the road. So if you guys enjoyed this video, make sure you remember to smash the like button, subscribe to the channel, and hit the little bell. If you think that this system is totally messed up and I should have to pay taxes sooner, take that up with the government, because these are completely legal ways to defer your taxes. And if the government came and said, hey, this is off limits, well, then you gotta pay the tax, and it is what it is. But right now, it's within the limits, it's legal, and it's a great strategy you can use to build your real estate portfolio more quickly, because you can defer those taxes, you can build your portfolio, it can give you the freedom to give back more, to take care of your family better, to have the things that you want now. So instead of complaining, go out there and take advantage of it. Now, again, if you guys enjoyed the video, smash the like button, subscribe to the channel. And if I didn't cover things thoroughly enough, please let me know. I know this is a more high-level video, but I've had tons of people ask for it. So hopefully you enjoyed it. Thanks, guys. Have a great night.